In this week's update, Wednesday's celebration gets dashed. Has the Fed waited too long? And the next phase of AI winners. My name's Garry Davis. As always, this is general advice only. And please remember to like and subscribe to the video. All right, let's start with our market perspective. What a week. Euphoria on Wednesday after the Fed indications that rates would be cut. And that all got dashed for a couple of different reasons that I'll get to on Thursday and Friday. And we saw the sharpest sell-off of the year. So it raises the question, and something that I've been pointing to for several months, and that is what might bring this market to its knees, and that's actually a Fed policy error. And it's looking very likely that maybe the Fed has waited too long in reducing interest rates and that things are starting to get away from them. So it's possible that that's the external influence that'll prick the bubble, if there is such a thing in the US market. Now, the Fed has got two mandates. One of them is maximum employment, and the other one is prices and inflation. And there's probably no question that they've had a pretty surprising degree of success with bringing inflation down, particularly given the way that the US government has behaved in terms of spending. So a tick on inflation, but the employment situation is now rapidly becoming an issue. The problem is that you can't just lower rates and everything adjusts very, very quickly. Sometimes it takes 12 to 18 months for the adjustment to occur to the change that's been made. And of course, by then, there's a heck of a lot of damage being done. And that's what the market freaked out about on Thursday and Friday, the fact that interest rates now have been held too high for too long. But there were some other things. So we've had multiple data points that are suggesting that the labour market is softening and softening very quickly. However, as with all things, you've got to take it in context rather than just look at the headlines or the raw numbers. But we have seen over the last 2 weeks the market response to Google's earnings and then also to Microsoft's earnings and also Amazon as well, where the market is now getting impatient for a return on investment on these extraordinary investments that these companies are making in building data centers and the development of artificial intelligence. So it was expected that there would be a return starting to flow through, and it's not coming through at anything like the level that the market was expecting. And so we've now got stocks that are trading on pretty high multiples that were priced around those investment payoffs, and they're not coming. So naturally, there is going to be an adjustment. The PE multiple is going to get dragged down by the prices falling. And how far has that got left to run? Look, it's impossible to say because it depends on market sentiment. The market can decide that it is happy paying mid-30 PEs for the Microsofts and the Amazons of the world, and next week it might only be comfortable paying 25 times. And that results in a massive shift in the price. And that's something it's dynamic. It's moving all the time. So we can never feel really comfortable that the market has got the multiple where it should be, if you like. So we had euphoria on Wednesday, and then we had fear and panic about growth and also the unemployment rate on Thursday and Friday. And it's now pretty likely that we're going to see rate cuts. It's virtually a 100% certainty that we're going to see rate cuts in September. The question really now is it going to be 25 basis points or is it going to be 50 basis points? And will the Fed have to follow up in November with another 50? And the bond market is certainly screaming that that is the case when we get to the chart. All right, now we've had some data points, but they are singular data points at this point in time. It was something the market wasn't worried about, and then all of a sudden it is. But we need to see the follow-up data points, and there is a perspective on that, which I'll get to in a moment. Now, there is something that most viewers probably haven't heard of. That's called the SARM rule, which is someone associated with the Fed in prior years. And that rule has, I understand, got near perfect validity in predicting recessions, and that rule has just been triggered. Now, that doesn't mean that it has to happen this time, because those sort of batting averages can always get disturbed. But for the record, this rule has 100% success rate, and it has been triggered. So it's possible that the US is already on the path towards recession, and that would be not good news for stock prices in general. So is the panic warranted? Again, I'll come back to that in a minute. Just for those that haven't heard of the SALM rule, it says that a recession is underway when the 3-month moving average of unemployment rises by 0.5% from its lowest point within 1 year. And so that has just occurred. However, there is a caveat on that. In July, 420,000 workers entered the workforce. I guess as most people are aware, there's been an immigration issue in America through the southern borders, in much the same way as there's been an uproar in Australia about the current high immigration levels. And so that has certainly contributed to additional workers in the workforce who have not yet been able to gain a job. So that sort of waters down the spike in unemployment from 4.1% to 4.3%. Offsetting that, consumer spending data is getting a little mixed, but it's still pretty positive. And business investment is still okay. So there are some positives here. So this is not necessarily a doom and gloom situation. And any of these economic rules or paradigms, if you like, have always got to be taken in context, because there can always be circumstances that create a one-off, and this might just be one of those. This is just a one-off where the SALM rule has been triggered, but we're not actually heading towards a recession. But it's probably pretty likely, if the Fed doesn't get their skates on and act very quickly, that we could end up in that situation. I think what's safe to say is that the odds of a recession has risen. Will the US economy tip into a recession and therefore have a significant impact on corporate activity, corporate profits, and therefore share prices? It's far too early to say. But I will say one thing, and that is that you should not look at the market as a single entity. So if the S&P and the NASDAQ goes down, that doesn't mean that there's not stocks that are going up. In fact, during all the turmoil over the last week and a half about particularly the big tech stocks, there were some stocks that went up, and Meta jumped 7%. And there were some great results over the last week and a half. So don't get caught up in what the general market is doing or might do. Just look at it on a sector-specific or stock-specific basis. And if you can identify great growth stocks that are beating earnings and have got a positive earnings outlook and growth outlook, then the prices, they might go through a very short-term little dip based on sentiment, but the prices are probably going to continue to trend higher. So they're the ones that you want to look for. But look, in general, the markets are not priced for a recession, that's for sure. They're not priced for mixed earnings, which we've seen some of. They were priced pretty much for perfection in many areas. So as usual, the panic reaction has started, and markets will probably go too far to the downside, and that is the opportunity. Now, it would be remiss of me not to comment about what could be building as one of the great opportunities of the year to get into some of the great stocks. The primary players are probably due for a bit of a rest. They've been trading at quite high multiples, not excessive given the growth, but quite high multiples. And we've now got some uncertainty. Will it end up in a recession? Will it end up in more softer earnings? No one really knows at this stage. Too early to say. But they're probably due for a rest, just based on probability. But for goodness sake, do not lose sight of them. The Nvidias, the Amazons, the Googles offer fantastic long-term opportunity. I still wouldn't buy them yet, but at a lower price, can they offer an outsized return over the next 5 to 10 years? In my view, absolutely yes. So don't lose sight of them because there could be a great opportunity building. But there's also an opportunity in the just amazing number and breadth of stocks that are going to be direct or indirect beneficiaries of AI. So the next level's down, and that some of them are already moving very strongly. Some of them have already doubled in the last year. But when you look at their outlook, it's still very, very strong, and most are still in their absolute infancy. So I believe there are stocks in America that can do incredible things over the next 5 to 10 years. And they're not expensive at this point in time. Now, just a couple of suggestions. And, obviously I'm going to be working on this. I have been working on this for some time for members, but just a couple of areas to highlight. All the various service providers to data centers, and that can include electrical installation work, power supply, cooling, data center efficiency. There's a whole raft of different areas that are and will be beneficiaries in the future. And then we look at infrastructure, building out the capacity of the grid, again, in all sorts of direct and indirect ways. These are a couple of examples, but they're all over the place. And it's not until you sit down and start to think about where these beneficiaries might be that you can wander off into all sorts of, seemingly unrelated areas. I mean, you cannot leave copper out of this because of the requirement of copper, the demand for copper in building data centers and building the transmission infrastructure. So it's very broad, it's very diverse, but there are targets galore. That's the message. All right, let's turn to the scoreboard. The S&P was down 2.1% across the week. The NASDAQ was down 3.1%. But I have to say there was some buying came in on Friday afternoon. There were many, many stocks, and most of the indices did close up off their lows, as we'll see. 6 of the 11 sectors were down. Tech obviously was the worst, but closely followed by consumer discretionary. And that's what you'd expect when there's a bit of a panic sell-off in these areas that were pretty buoyantly priced. The US dollar index was also down 103.24, and that's related to what the bond market is screaming about, and that is lower prices or lower bond yields. And the 10-year yield was down very sharply. You might recall it wasn't that long ago that it was over 5%. We're now down under 4%. In fact, we're now down under 3.8%. So that was a very sharp fall across the week. And the VIX accordingly jumped up very strongly to 23.4. Let me just have a look at, just want to look at the bond market. So this is the 10-year yield. That's on the day so that you can see what happened. There was a very, very sudden plunge when that Friday data came out. But let's look at it over the last month. You can see a very dramatic shift from above 4.25 down to under 3.8. So that's been quite an amazing move. All right, let's look at some of the charts. There's the S&P on a daily chart. So first of all, we'll have a look on the weekly. There's the weekly. So down 3 weeks in a row now, back to the 20-week moving average. Whether that will prove to be a support level or not remains to be seen. But when we go to the daily, you can see that the dimension of the panic on Friday. So the back-to-back poor data on Thursday and Friday was just too much for the market, and there was a significant gap down, then traded down almost to this support level. But you can see the buying that came in, and the same sort of thing happened on the NASDAQ. That's the NASDAQ on a daily. And you can see, just step back and look at, during this phase from here to here, look at the number of green candles as a percentage of the total. And then look at the number of red candles from here down to here as a percentage. So you don't need to know much about charting to understand that there's been a significant shift in sentiment. The character of the market has changed. And again, we got a gap down. Gaps are always indicative. We have a gap here, and another gap here. They're always indicative of some panic selling. It means, the sellers are just lined up and they're desperate to get out on the open. But we did steady to a degree. And this is a logical support level. You would expect to see some support coming in at this level. Now, whether it holds or not remains to be seen, but I am reminded by the observation that I've made over decades, and that is that when sentiment is bullish, then support levels tend to hold and resistance levels tend to break. When sentiment turns bearish, the opposite occurs and support levels tend to break. So I'm not feeling particularly confident that the NASDAQ will bounce from here. We might get a little bit of a bounce, but I really think sentiment has shifted so abruptly, and in part it's warranted. I think it's probably getting overdone, but in part it's warranted because there is a probability the US market could tip into recession. That's not to be dismissed. Looking at the equal weight S&P, we got a bit of selling, of course, on Thursday and Friday, but nothing like the S&P. And if we look at IWM, it also sold down last week, but most occurred at the end of the week, and a lot of it was on Friday with this gap down, and again, it steadied very quickly. So I'm just not seeing the sort of real disaster scenario that, of course, some of the media are painting. Let's drill down a little bit. We've looked at the NASDAQ. That's where more of the damage was done. This is SMH, so we're looking at the semiconductor sector, which needs to do well for the market overall to be doing well, and it's even a few notches worse than the NASDAQ. Lots and lots of red candles, lots of big red candles, lots of gaps. So you'd have to say that at the moment, the short-term direction is down, there's no question. But it's probably going to get overdone. It might already be overdone, so get prepared, because some of the world's greatest ever wealth compounders are going to be cheaper probably next week or next month, and they will provide wonderful opportunities. With these sort of stocks where the long-term direction is up, then just think about it. If you can buy a 20% discount, then you've immediately and by definition improved your long-term return. So you shouldn't be scared away from little periods like this. You want to embrace them as opportunities that you've been starved from or starved of. NVIDIA, it's definitely an opportunity building here. There's been a lot of debate of late about whether NVIDIA is too expensive or not. I've presented several times that I don't believe it is. I think the growth rate and the near certainty of that growth rate over the long term well and truly justifies the current multiples. But that doesn't stop the market selling off, and we may get an even better opportunity. But I can tell you, the lower the price that NVIDIA goes, the better the opportunity, because I don't see the end point for NVIDIA in 3 years, 5 years, 10 years' time as being any different. So weakness in stocks like NVIDIA are a fabulous opportunity. There's the spread between the semiconductor index and the S&P, and naturally, of course, it's come off quite sharply. And so again, this is a change of character. So this may continue for a little bit of time. I really have no idea. I know what it looks like, but in the period in the middle, I just keep an open mind. I don't set targets or decide that I'm going to take a particular action. I just keep an open mind, and I let the market bring me into a stock and also take me out of a stock. And that's the most reliable way to do it, because that's putting your emotions to the background. Let's look on a sector by sector basis. Healthcare did the best towards the end. So this is over the last month, but you can see the last little bit will obviously reflect the last few days. So healthcare did well. Consumer staples, of course, did relatively well. Materials have been going okay. That's helped a lot by gold, of course. But then you've got all the major technology, XLC, energy, consumer discretionary, and then, of course, at the bottom is XLK because of the treatment handed out to big tech, and there were some really bad ones. Intel was down, I think, something like 25% on an absolute shocker of a result. But look, Intel has been a relative basket case for quite some time, many years. The Australian market, we saw selling in everything on Friday: healthcare, finance, small caps, IT, materials, and then energy at the bottom. Nothing was spared in the Australian market. And it's going to be interesting to see how the Australian market trades, because if the US had closed on its lows on Friday, then I think the Australian market would have opened on Monday very, very badly. But the buying support just sort of muddies the waters a little bit. Our market may not be too bad, I suspect, and that much of the selling might have already occurred. Anyway, we shall see. Just checking in on the currencies. Sharp move on Friday in the dollar, and that reflects what's happening in the bond market and expectations around what the Fed's going to have to do in September. So don't be surprised to see a 0.5 percentage point. The Aussie dollar didn't jump up as much on Friday as you would expect. And so that's perhaps pointing towards some continued weakness in commodity prices. Just while I'm here, let's have a look at the Aussie market. Just for the exercise, this is the Australian index, the ASX 200, on a weekly chart. So you can see we were looking pretty good until Friday. So things were looking really, really good. Thursday was okay. A little bit of late selling, but Friday really brought that unstuck. Okay, so just quickly whizzing through. 65 was where our dollar finished. Our market up 0.3, but very likely it'll probably be down. IT and real estate made solid gains across the week, but they were the biggest decliners on Friday. And the only place to hide on Friday in the Australian market really was the gold market. And there were a number of gold stocks that did really well. Speaking of precious metals, gold added $57 to 2443, but did hit a spike high of 2478. Translated to Aussie dollars, with the weaker dollar across the week, we're up to 37.53. So this is very profitable territory for Australian producers. If we look at the Australian market, was really productive for gold stocks. But if we look at GDXJ, so if we look at the global players, they're down a little bit, but they're holding up pretty well. And who knows where tensions in the Middle East are going to lead. So not surprising that we're seeing some positivity in the gold market. And I'll just quickly whiz into the gold stocks. First, we'll look at silver. So silver is still up and down, pivoting above and below this $30 level by about $2.50. So we're sort of fluctuating between $27.50 and $32.50, and have been for quite a number of weeks. That's the US dollar gold price on a daily basis, and you can see we formed a double top with the little spike that we got on the 17th of July, but unable to hold it. So quite a bit of volatility there. And if we look in Australian dollars, looking pretty buoyant, and actually hit a high of over 3,800 during Friday night session. All right, other commodities, copper was down a fraction. Nickel was actually slightly higher, but obviously way down on where it was a year ago. In copper, BHP has done a $3 billion deal with London Mining in Argentina. But when you step back and you look at the situation, this is not doing anything to really increase the global supply of copper, which is, if you believe the assessments, then copper demand over the next decade or two is going to double. And you just can't switch those major mines on. They take 15, 20 years to develop. And all that's happening is we're getting M&A. That does nothing to address the supply issues. So it's positive intent, but it's not solving the situation. So I think it's absolutely inevitable that we see copper trading significantly higher. It just has to. That's the economic reality. You need a higher copper price to provide the incentive for the BHPs of the world to go out and do more grassroots exploration. Crude oil dropped very sharply down to 73.5 despite the undoubted concerns about Middle East supply. So that was pretty extraordinary, and perhaps it's a reflection of where the big players see demand going both in the US and in China. And part of that, certainly in the US, was that the jobs report really does bring into question what the US demand will be. And we've seen some data of late that China manufacturing activity is on the decline. But boy, that's a pretty sharp fall in the crude oil price. Just a quick update on uranium, because it was a hugely negative week for uranium stocks. The uranium price was down a touch, but it's very difficult to really know what the real market price is for uranium, because so much of it is done in long-term contracts. But what really killed the market is the world's largest producer in Kazakhstan. Their output forecast was surprisingly positive, caught the market offside, and that absolutely killed stocks. I mean, there were declines in Australian uranium stocks, emerging stocks that are going to be producing very soon, of up to 20% on Friday. It was an absolute bloodbath for uranium stocks. So that's a sector that, you go back 3 to 4 months, was one of the hottest sectors on the market, and now it's absolutely in the freezer. So again, opportunity long term. I certainly wouldn't be buying into uranium at the moment, but long term, absolutely, because uranium is not going away. And uranium would be another one that you could add to the list of beneficiaries associated with data centers. You know, data centers absolutely require 100% certain baseload clean power. And there's probably nothing better than either coal or uranium. And of course, uranium is going to get the tick every day of the week in that comparison. There's the spot copper chart, not a lot of change, but the crude oil price has come down very sharply. It was only back early in July, so only a month ago, that we were trading at 84, and now we're down to 73. So it's been a very sharp move in crude oil. Wrapping it up, corrections are just the best of times. They really are. A lot of people get worried because of the value of their stocks. They're worried about the value of their stocks falling, rather than salivating at the opportunities that are being created to buy some of the world's best companies at discount prices. And the world's great long-term compounders, you only get a shot every now and again at buying these. And I'm reminded of an analysis I've done many times around Apple, which has gone up just tens and tens of factors over the last 20 years. And yet on 4 occasions, that price has dropped by close to 50%. With the benefit of hindsight, they were absolutely magnificent wealth-building opportunities to buy into Apple on a correction. And chances are we're going to see the same thing with Nvidia, with Amazon, with Google. I'm almost hoping that the correction this time is bigger, and short and sharp would be ideal. We've then got the beneficiaries of rotation, the small and mid-cap stocks that have been left behind because everyone has been so besotted with these large cap tech stocks. And now the market is starting to realise that these stocks, they're great growth stocks, they've got terrific outlooks, and they're cheap. So there's all those beneficiaries there. And then we've got the emerging future champions, the next generation of Amazons and Googles and Apples. There's not a lot of them, and we're not sure which ones. It'll only be with the benefit of hindsight. But if you own a bunch of them, then you only need a couple to emerge. That's all you need to do, just a couple. So just have exposure across some stocks that have got that sort of potential. And in Australia, I've identified perhaps 20 that have got that potential. Now, only a few will emerge as real stunning winners, but that's okay. I can wait. It's just all about process, having a process to identify what are the factors that feed into these stocks, what makes them great over the long term. And it's not rocket science. So you just go and look for companies that have got those factors, and you own a bunch of them, and you be patient, and you manage your weightings, and you'll probably get a pretty good result. So the message out of this week is absolutely get organised and get going, because corrections is when you really want to be interested, not when the market is trading at all-time highs. Portfolio analyst last week was about just being alert to the transitions, to the rotations, because they do create opportunities. And we also looked at, in the US, certainly growth opportunities, because that's all I look at, but also value opportunities. So the two things combined. So really strong growers that are trading on low PEs. So what really gets me excited is earnings per share growth of 50% trading on a PE of 10. And they exist. You just got to wear out some shoe leather to find them. So very, very exciting period for me. So don't get put off by what happened in our market on Friday and what may continue to unfold for a few more weeks. Look at it as an opportunity, not as a problem. There's more information on the website. There's my email address, and I'll be back with you next Sunday. Cheers.